Today on The Bottom Line, great news and bad news. More about Bitcoin and Scott Galloway from NYU on everything. Hello, everyone. Welcome to The Bottom Line. I'm Henry Blodget.
I'm Sara Silverstein. We have a great show today. We're at the NASDAQ market site in Times Square, and thank you to Fidelity Investments for sponsoring the show.
We will start with the good news, and there is a lot of it. Yet another week of market highs, bulls cheering, everyone get more enthusiastic about the stock market. President Trump is again bragging about the performance, and certainly since Election Day, by midweek, almost 20% from Election Day. And if you're pro-President Trump, you can congratulate him about that. But also worth noting that, in fact, Obama's last election, it was up also 20% from Election Day through this period. So lots for both sides to take credit for. But moving to the bad news, as we have talked about many times on The Bottom Line, prices are hitting almost record levels. Prices relative to fundamentals like earnings and cash flow. And the problem is that over the long term, at least historically, price has been a good indicator of long-term future performance. Specifically, when prices are low, long-term performance is high, and when prices are high, long-term performance is very low. This is something that John Hussman, many others have talked about, and we've talked about on the show. The other problem right now is it's not just stocks that are expensive. It is also bonds and cash. So the usual cure for an expensive stock market, which is diversification, may not actually help you out that much if you're investing for the long term. In fact, John Hussman this week, a portfolio manager, looks at the average that you can expect from a portfolio, stocks, bonds, and cash, and it is at one of its lowest levels ever. The good news is we will end on good news, which is it's still positive over 12 years. Hussman estimates that you'll have a return of about 1% per year over the period, a far cry from the 6 to 7% of a diversified portfolio from normal valuations, but still positive, so it could be worse.
And that's nominal 1%.
Absolutely.
Right? So
My
it's
goodness.
Fairly positive.
We're doing great. Yeah.
Yeah. But I mean, I do think that there are things about this, and I know last week I was a little more bullish than you, but I think that there's a lot of this that makes me nervous, the desperation for yield across all asset classes and raising everything up. So that scares me a little bit.
Yes, and this is a big difference from prior bubbles. In 2000, for example, stocks were extraordinarily expensive, but bonds were yielding 6%. Of course, at that point, everyone said, 6%? That's pathetic. I want to own stocks that go up 20% a year. But now you'd look at that 6% and you'd say, well, I want to own some bonds. That's great. But here we are, bonds yielding 0.5%, 2%. Not much solace there. So everyone is, as you say, chasing yield.
Yeah, and even the housing market is looking expensive again, or at least above the long-term average compared to rents. And even the private market money's moving there. And of course, Bitcoin and the cryptocurrencies. So it is a little concerning.
Yes, so unless you think it's different this time, which you're welcome to your opinion, if so, we are headed for a long-term period where financial assets will disappoint.
On Tuesday, Alibaba briefly overtook Amazon in market cap for the first time in 2 years. Both right now are hovering around $470 billion. About 2 months ago, Henry interviewed Bill Kennedy, Fidelity portfolio manager, who talked about his reason for being invested in Alibaba, saying that China is a big consumer market and the retail space hasn't developed to the extent it has in the United States. Alibaba is actually leapfrogging a lot of brick and mortar retailers that are in China. He says there is not a lot of competition, so Alibaba is very well positioned. He also says that Alibaba is looking outside of China. However, they don't really need to because of the low penetration and the profit margins, and they're actually producing cash flow, that they're actually doing okay, and he likes them just for China or potentially for another emerging market in the future. And that's today's Fidelity Insight. On Tuesday, Vladimir Putin hinted at a crackdown on cryptocurrencies in Russia, but Bitcoin did not seem to mind. It hit an intraday high, according to data from Bloomberg. Also this week, we heard from the former Fortress hedge fund manager, Mike Novogratz, who's starting a cryptocurrency hedge fund with $500 million. He says that Bitcoin is going to go to $10,000. Also, we heard from Kenneth Rogoff, who used to be the chief economist at the IMF, and he said in the long run, the technology will thrive, but the price of Bitcoin will collapse. This is interesting. Rogoff's point of view is interesting because he's not on one extreme or the other. He's not saying it's a fraud and it's a scam, but he's not saying it's going to take over the world.
That's right. We have a very wide range of opinions from smart people, which is what you have in any sort of market. Always disagreement, and so it's very healthy here. Doesn't change my view, again, that Bitcoin is just the perfect asset for a speculative bubble, because there just is no argument you can make about valuation anywhere. At $1, at 10,000, at $1 million.
But what about a comparison? What about to gold?
What about to gold?
What about as a comparison to gold?
What
So
what?
Valuation, all you need is
No.
something.
What about a comparison to GDP? It just doesn't matter. You can make it up. People have these wonderful stories and they sound so smart. It's just crap. It is all about supply and demand. The good news is there is a fundamental. People do use Bitcoin to trade things and buy things a little bit, and those transactions are going up, so it's not just greater fool, someone else is going to pay more for it. But please, tell me you have heard an argument that is just complete hogwash. Make it up. Oh, it's worth X percent of gold. It's just crap.
Well, I do, and I will say, I don't think that just being able to spend it is necessarily the most important thing, but I think that because that's how they're paying people to keep the blockchain going, and because of the future uses of the blockchain, that could be an argument for a valuation, no?
No, there is a finite number of them. And we haven't even mined them all yet, just as there is a finite amount of gold in the world. But the idea that you can somehow equate the two or they're relative,
the value of the...
it just doesn't make any sense
at
all. But this is another reason why it's such a great thing for a speculative bubble, is they may be able to make more Bitcoin by forking it and then it's a related currency, but the Bitcoin itself, unless somebody gets in there and messes with the code, there are only going to be 21 million of them, so everybody can fight over them and their price will go up.
That's the same for gold.
But it doesn't matter. It could be 3x.
We can do this forever. Yeah. We'll do it again next week. I'm here with NYU professor Scott Galloway. Thank you for joining me.
Thanks for having me.
And the author of the new book, The Four, The Hidden DNA of Amazon, Apple, Facebook, and Google. Sorry, I had to read it off the cover.
Yeah, rolls right off the tongue.
So this book is all about the big four companies and what they mean to us and how they came to be and some of the shortcuts that some of them took to get there. Can you talk about those?
Sure. So I think these companies have literally disarticulated who we are as people. I think Google is a modern man's God. We trust Google more than a priest, a rabbi, a scholar, a coach. 1 in 6 questions posed to Google have never been asked before in the history of mankind. What other authority has so much credibility that 1 in 6 questions have never been asked before? I think Facebook calls on our instinct to not only be loved but love others, mostly through photos, catalyzing connection. Amazon is our consumptive gut. Always more for less is a winning business strategy, and right now, Amazon's the best in the world, and I think Apple communicates with our reproductive organs. I think your iPhone is the new symbol that you have good genes and that you're attractive to potential mates. So they've literally disarticulated who we are and reassembled them in the form of for-profit companies, and since the Great Recession have added more shareholder value than the market capitalization of India. And I think these companies are amazing at what they do, but I don't think they endure the same scrutiny as the rest of the corporate world.
And you just said Amazon is the best.
Yeah, so if you were going to rename the book The One, or the sequel is going to be called The One, you would probably pick Amazon. Wherever Amazon is bumping up against the other three, it's winning. In the voice wars, it's literally beating the crap out of Siri in full view of everyone with the buttery voice of Alexa. Where it competes against Facebook and Google, Amazon Media Group is now growing faster than Facebook or Google. It's $1.5 billion, 3 times the size of Snap's, probably going to be bigger than Twitter in a couple of years. Where they bump up against Apple in streaming video or in hardware. Most innovative hardware product of 2015 and 16, not the Apple Watch, not the Pods, Amazon Echo. Fastest growing offline retailer soon, Amazon, in addition to being the fastest growing online retailer. Oh no, by the way, the most profitable, fastest growing segment in technology, the cloud. They're #1 with tripled market share of the #2 Microsoft. So everywhere Amazon is bumping up against other tech players, it's winning.
So, and you've talked before about how Amazon has an advantage over other companies that are built in, sort of. What are those?
So people might say Amazon's core competence is operations or analytics. I would argue that it's storytelling, and that is the original investor letter from Jeff Bezos said we're going to invest massively in these truisms that are non-perishable of consumer wants, and that's, I think, it was value, selection, and convenience. And their ability to paint this extraordinary vision that the markets have bought into in a big way have resulted in access to the cheapest cost of capital in the history of modern business. This is a company that's never been really profitable over 20 years and can access the credit markets at a lower rate than China. This is a company that has the market capitalization of almost every major retailer in the U.S. that we talk about. You could add Walmart, every department store, and then the largest grocer, Kroger's, and you still don't have the market capitalization of Amazon. So Amazon can show up with more capital and overwhelm any sector. And to use a war analogy, at the end of World War II, the Germans had better artillery, better trained troops, better morale, but the Allies had 38 gallons of gasoline for every one the Germans had because we cut off their supply routes. Amazon is the business that shows up with 38 gallons of gasoline. They can literally overwhelm the competition with brute force.
And the market cap, they are bumping up like neck and neck with Alibaba right now. How do they compare?
So the honest answer is I don't understand Alibaba. To me, Alibaba feels to me like a company that's got some of the worst corporate governance in the world. And if we didn't know the brand and the business stories, we wouldn't know them. Do you use Alibaba at all? So while China's an exciting market, second largest economy in the world, maybe the biggest in 7 to 10 years, I would argue it's not playing on the same level as the four, because the four have dominance in dozens, if not hundreds of countries, whereas most Chinese players get their market capitalization from their domestic efforts. So I think these companies are actually on a different level.
And Alibaba is one of the ones that could be the fifth that you talk about, and Tesla is as well.
Yeah.
And Tesla's value, I saw something, I think it was from RBC this week, or it says it's really going to be the supercharger network. I've heard other people talk about the information that they're collecting. Where do you think Tesla's value is coming from?
Well, Tesla, again, has painted an unbelievable vision, right? I mean, this guy's he is the guy we all want to be when we grow up when we're 8-year-olds. Rockets, cars, charging electricity. But think about the market capitalization of Tesla, a much greater market capitalization than Ford. Ford sold 8 million cars last year, 6 million cars. Tesla sold 80,000. And yet Tesla has dramatically higher market capitalization now, I believe, than Ford Motors. So this, again, is incredible storytelling. This is a bet on the promise, not the actual performance so far. The biggest lesson old economy companies can draw from Tesla is that old economy companies were used to being told to under-promise and over-deliver. Tesla's in the business of over-promising and under-delivering, and it's working because the vision is so intoxicating.
And Facebook recently, there was the news about the Russia involved in the election, and you wrote some pretty strongly worded stuff about their responsibility there. Can you talk about that?
I think Facebook has openly embraced the 90-plus point gross margins of a media company. They've embraced the celebrity of a media company. They've embraced the influence of a media company, yet they seem to be allergic to the responsibilities of a media company. First, they started saying, we're not a media company, we're a platform. That's like McDonald's serving 80% fake beef, and then when coming under criticism saying we're not a fast food restaurant, we're a fast food platform. I don't think we would tolerate that, nor should we tolerate that excuse from Facebook. You create content, you run advertising against it, boom, you're a media company. I worry. The average age of the Cleveland Cavaliers players is 29. Average age of the San Jose Sharks players is 29. Average age of Facebook employees is 28. I worry that the management there doesn't have the historical context for the importance the Fourth Estate plays in our society. I'm pretty certain that Business Insider wasn't weaponized by an intelligence group of the Russian government, and nor are you going to, because you employed this very expensive thing called human discretion. And the excuse right now from both now Google and Facebook is that it would be impossible for us to screen our content and our advertisers, which is total BS. We're not talking about the realm of the possible, we're talking about the realm of the profitable, in that this would definitely hit their cash flows, definitely hit their stock market capitalization, but if the New York Times can protect us from the GRU with $90 million in free cash flow, Facebook can figure it out with $12 billion in cash flow.
With more people or more technology?
The answer is yes. They've been doing these half measures. They announced 250 people, got a lot of grief for that, announced 1,000. Facebook could hire 10,000 people, spend $250,000 a year in artificial intelligence to help those 10,000 people identify, sort, and stop controversial content, and it would maybe ding 5–10% of their cash flow. This is, again, going back to the hamburger analogy. You have one McDonald's serving 1 million burgers a day, one serving 1,000, and the McDonald's serving 1 million burgers a day would say, we can't check the beef quality because we're so profitable and we're selling so many burgers. You have the weaponization and subterfuge of our democracy, and you have the profitability of big tech. I know which side I'm on.
So as far as the profitability of these 4 companies, what's the biggest risk to it?
The only thing standing between these 4 companies, and I think each of them $1 trillion market capitalization, is probably government intervention. And it's not going to come from where we think it's going to come from. It's not going to come from Washington. It's likely going to come from Europe. In the US, we register tremendous benefit and upside from these companies. Amazon's the biggest recruiter from my class at NYU Stern. They do create economic value. They're the envy of the free world. They're great for our brand as innovators and our country's brand. There's some serious downside around privacy concerns, some of the weaponization things we mentioned, around job destruction. But Europe registers all of the downside or all the risks with a fraction of the upside. There aren't many university buildings or hospital wings named after Facebook or Google employees in Europe. They aren't recruiting as many people out of the Bocconi and INSEAD as they are out of Stanford, MIT, or NYU, or Booth. As a result, that has stiffened the backbone of the regulators in the EU. In the next 12 months, you're going to see the mother of all fines come out of the EU against one or more of the big 4, and it's already starting. They're fed up, and they don't have the upside. They're just not going to put up with it.
And outside of the big 4, is there anyone else that you think is overvalued or is not running their company right?
Well, you would argue that Uber's probably been the best lesson in poor corporate governance and how it can destroy tens of billions of dollars in shareholder value. Uber corporate governance and the board was turning into the place where reputations go to die. I mean, the board had become apologists for terrible behavior. It probably took their value down $20 or $30 billion. The high watermark there was 70. You would argue that poor corporate governance here and an inability to step in and make hard decisions probably cost that company $10 or $20 billion. I think WeWork is dramatically overvalued. If you look at the valuation on WeWork, the floor they rent out, great business model, is now worth more than the building that they rent the floor from. So a great company, great management team. Is it worth more than Starwood and Marriott combined? Probably not. And I worry that the barriers of entry aren't there. I think Snap is still dramatically overvalued. We were hoping Snap would be the Facebook of video. The Facebook of video is Facebook, specifically Instagram stories. So I think that has a long way to go down. And Twitter needs to figure out how they turn their relevance into some sort of profitable business model, which they haven't. Twitter could be the New York Times or the PBS of our age in that it is more relevant than it is profitable and never gets the market cap that people are hoping for. So there's a lot. In this market, it's super easy to find overvalued companies.
And last question, what do you think about Bitcoin?
So I don't understand it that well. My colleague, Professor David Yermak, is kind of the big brain professor of finance on this topic. I would distill it very simply down to Bitcoin is pure speculation. Initial coin offerings are pure fraud. And the blockchain is where the innovation is. The blockchain could, in fact, revolutionize every business that's based on based on a ledger, whether it's banking, accounting. There's a reason Jamie Dimon hates the blockchain, because that might mean these financial complexes could be a shadow of themselves if the hype lives up to what it's supposed to be around blockchain.
Scott, thank you so much.
Thanks for having me.
That's it for this week. Thank you so much for watching. I'm Henry Blodget.
I'm Sara Silverstein, and before we go, I have to say congratulations to Chicago Booth's Richard Thaler on his Nobel Prize for Behavioral Finance. Well deserved. And of course, thank you to Fidelity Investments.
We'll see you next week.